moving to the heading called as income from house property. Moving to the next set of income called as income from house property. A very simple, straightforward heading, nothing great to discuss in this chapter. So let's quickly understand this chapter. We are moving to the head of income called as income from house property, which basically comes and says that if you want to tax something under the head house property, there are two conditions to satisfy. Condition number one is that there should be an house property. Second is that the house should be owned. The house should be owned. Satisfy two conditions, the income will get taxed under IFHP. If it is not satisfied, it will not be taxed under IFHP. You will move to the other heads of income. Yes. Scenario number one, if you are having any kind of land and you are renting a land, it is taxable under IFOS because there is no house property. Scenario number two, you have taken a house, you have rented the house to someone else. For you, this income will become IFOS because again it is subletting. Again it is subletting. So understand there are two conditions to satisfy. One is that there should be a house. Second is that there should be an ownership to the house. This is what the rules are. Yes. Yes. In this, they are coming and saying that Rahul, what is a house? House is any kind of building with the land attached to it. House is any kind of building with a land attached to it. They have not given any conditions, no nothing. They simply, you have a land and a building attached to it, then it is called a house. Whenever you discuss about the house, any ancillary items are also considered. Like if you have a garden against it, parking garage against it, all are considered, all are part of it. At the same time, they are coming and saying, boss, ownership is extremely mandatory. If you don't have an ownership, you will not be taxed under that HP, but you will be taxed under IFOS or PGVP with just one exception to it. What is the exception? We'll discuss right now. They're coming and saying that, boss, generally I'm looking for an ownership, but I also permit something called as deemed ownership. Where you have tried to give the ownership of the house to someone else because you wanted to cheat. What are the examples? They're coming and saying a transfer of a house happening from the spouse to his spouse. The condition here is that there should be an inadequate consideration. Then only it is clarified that it's done for avoidance. So it's a transfer of a house between one spouse to another spouse for inadequate consideration. The house will be considered as owned by me. With an exception that if the house is given because of a agreement to live apart, or in simple words, divorce, then in that case it will become a new ownership. Second condition, I'm coming and saying, no, I did not transfer to my spouse. I gave it to my son's wife. Again, inadequate consideration. Then in that case, I'll become the owner. Exception is minor married daughter because it is covered under clubbing. Then last scenarios are not important. The last scenario is important, which comes and says, you have a house which you have rented for more than 12 years. If you have rented for more than 12 years, then in that case, you also become the owner. This is the only exception to subletting where I'm coming and saying if you've rented a property to someone for more than 12 years, you have now become the deemed owner. Therefore, your income will become taxable under HP. These are the simple conditions of HP. Coming to the part of HP, they're coming and saying, boss, when it comes to HP, you have two kinds of house properties. One is called as self-occupied property, one is called as let-out property. In self-occupied property, they are again putting a further subdivision, coming and saying you can only have two properties as self-occupied property at the option of assessee. Balance properties will become DLOP. It will become deemed let-out properties. If you have a format of SOP, LOP and DLOP, answers become simpler. So therefore, the format in the book basically comes and says you have to start from municipal value or fair value, whichever is higher, compared with your standard rent, whichever is lower. This answer will give you what is called as expected rent. This expected rent will be compared with my actual rent. Hold. When you talk about actual rent, it is not the actual rent which you receive. It is the actual rent which you would have received if you had not vacancies. So they are coming and saying compare your expected rent with the actual rent, ignoring vacancies, whichever is higher. If I find out that your actual rent ignoring vacancies become higher, I find you as a genuine assessee. The moment I find you as a genuine assessee, your vacancy loss will be allowed as a deduction. If I find out that even after me considering the vacancy, your expected rent was more, then I will directly take the expected rent. I will not care about your vacancy loss. We'll do an example. So it is expected rent or actual rent, whichever is higher. That will become your gross annual value. In this, you will reduce something called as municipal taxes. You will arrive at your net annual value. This net annual value, please understand, is only applicable for LOP and DLOP. It is not applicable for SOP. SOP Puerto Rico, municipal tax is not allowed as a deduction, so NAV will also become 0. NAV will also become 0. If you have an NAV, include inside one more item called as arrears of rent or advance rent. Advance rent or arrears of rent, you will now get a net NAV. You now get a net NAV. On this net NAV, you will allow two deductions. One is your 30% standard deduction and interest on loan. Interest on loan. You make those two deductions, you will get income from house property. You will get income from house property. This is what the conditions are. Yes. What is municipal value? The value decided by the municipal authority. In case it is not given, they have given a different formula. You can take the municipal tax divided by the percentage. You will get the municipal value. What is it? You can do municipal tax divided by municipal tax percentage. Okay. Generally, municipal tax is levied on the value of the municipal. Therefore, they will come and tell you that the municipal tax is 10,000. The percentage is 10%. Automatically, it becomes 1 lakh. Automatically, it becomes 1 lakh. So, it is municipal value versus fair rent. Fair rent is nothing but the rent which is decided by the open market. Decided by the open market, whichever is higher. Compare with standard rent. Standard rent is the rent which is defined by the Rent Pollutions Act, Rent Control Act, sorry, not Rent Pollution Act, Rent Control Act, whichever is lower, that will give you the expected rent, will be compared with your actual rent. Now, from ICA perspective, ICA comes and says, whenever you talk about actual rent, it is not just actual rent, it is actual rent minus unrealized rent. What rent? Actual rent minus unrealized rent. Technically, unrealized rent should be reduced from your GAV only, but ICA comes and prefers it directly from actual rent. So, we will also follow the same method. Same method is actual rent minus unrealized rent. What is unrealized rent? We'll discuss, but it is actual rent minus unrealized rent, and this should be ignoring vacancy. This should be ignoring vacancy. Rahul, what is this vacancy issue? Notice this example. Look at the first example. It's coming and saying that the expected rent is 2,10,000. The monthly rent is 20,000, which means for the whole year you would have got how much? 12. So 2,40,000. For the whole year you would have got 2,40,000. You have expected 2,10,000. Who's expecting 2,10,000? Government. Government is expecting 2,10,000. You are ready to pay 2,40,000. You are ready to pay 2,40,000. If you are ready to pay 2,40,000, government is expecting 2,10,000. Your rent will become 2,40,000. But because it became 2,40,000, I found you as a genuine assessee. Because you are a genuine assessee, I will come and say, claim the vacancy loss. If you claim the vacancy loss, your rent will become 2,10,000. 2,10,000. Clear? Yes. Look at the same example. I'm sorry, not 2,10,000, 2 lakhs. Because the actual rent is 2 lakhs. Yes. Come to the second example. I'm coming and saying government is expecting 2,50,000. Your monthly rent is 20,000, which means yearly rent will become 2,40,000. Compare 2,40,000 with expected rent, it becomes 2,50,000, which means government was expecting 2,50,000. You are ready to give only 2,40,000. Government will come and say, I want rent on 2,50,000. Now, because government is expecting 2,50,000, but you are ready to give 2,40,000, government will say you are non-genuine assessee. If you are a non-genuine assessee, will they give you vacancy loss? No, they will not give you vacancy loss, which means your rent will now become the whole expected rent, which is 2,50,000. Which is 2,50,000. Clear, not clear? Yes. Come in the last example. The last example comes and says that the expected rent is 2,40,000. The expected rent is 2,40,000. Your monthly rent is 20. If your monthly rent is 20, your annual rent will become 2,40,000. Government was expecting 2,40,000. You are also ready to give 2,40,000. GAV will become 2,40,000. But because you are doing what the government is expecting out of you, you are a genuine assessee, which means government will allow you vacancy loss, which means now your rent will become 2 lakhs. Your rent will become 2 lakhs. With me till here? Yes, this is your vacancy loss. Any doubts? No. You have arrived at a GAV. On the GAV, you will now reduce something called as municipal tax. Income tax comes and says, boss, municipal tax is a tax which is paid by the municipal, which is levied by the municipal authority and will be allowed to you only in the year in which you actually pay. In the year in which you actually pay the tax, you will get the full municipal tax. It doesn't matter whether you are paying the municipal tax for the current year, past year, next year, next to next year, doesn't matter. Whenever you pay, you get the full deduction. Whenever you pay, you get the full deduction. This municipal tax will be claimed only for LOP and DLOP, will not be claimed for SOP. Will not be claimed for SOP. Please understand, whenever you're talking about municipal tax is allowed as a deduction. If you delayed paying municipal tax, you will be levied interest and penalty, cannot be claimed. You will only take your municipal taxes. With me? Yes. After you allow your municipal taxes, you get something called as NAV. In this, you include two items called as arrears of rent and advance rent. I told you already in salaries also, what is arrears of rent? It is a rent which is changed retrospectively. In that case, it will become taxable in the year in which you have received or known about it. Where at the same time you have advance rent. Advance rent means you have received rent for future years. You've received rent for future years. It doesn't matter, both are taxable. It doesn't matter, both are taxable. And then you have something called as unrealized rent. What rent? Unrealized rent is nothing but bad debts. Is nothing but bad debts. Income tax is coming and saying that, boss, if you were planning to get some rent, but you did not get that rent, you can claim it as a bad debt subject to 4 conditions. Subject to 4 conditions. Condition number 1, tenancy should be bona fide. Condition number 2, you have tried to get the money from him. If he did not give the money, you have tried to ask him to vacate. You've asked him to vacate. If he has vacated, you have not given him some other house. You satisfy these 4 conditions. Whatever rent you were not getting, you can claim it as a bad debt. But please understand, you can claim it as a bad debt only from actual rent. You can claim it only from your actual rent, which means expected rent versus actual rent minus unrealized rent. Whichever is higher. This is what the policy is. Yes. At the same time, if you have got a rent as bad debt, in the future you may get it back. This is called as realization of unrealized rent. In that case, it will become taxable in the year in which you receive it. In that year, I don't care whether you are owning the property or not owning the property. What you get is taxable. But please understand, since you claimed it as a deduction earlier, your 30% also fell earlier. So therefore, in the year in which you realize, that year you will get the 30%. That is why in my format, it is before NAV. NAV la add பண்ணிட்டீங்கன்னா automatically 30% வந்துரும். Yes or no? Yes. After you complete that, you get NAV. In that NAV, you have to reduce 2 items. First item is 30% of NAV, standard mandatory rule. At this point, I want to clarify to you, if you are in salaries chapter or you are in HP chapter, if you should be extremely careful on what the question says. If the question says salary received, it means what you got in your hand is the actual money. In which case in salaries you have to reduce 50,000, in HP you have to reduce 30%. If the question comes and says no income from salaries, then in that case assume 50,000 is already given. Assume 30% is already given. Yes or no? If the question says computed, then also it is assumed that it is given. But please understand, you have to be extremely careful about it. If you are in salary chapter and the question comes and says salary is computed as per 115 BSc. What? Salary is computed as per 115 BSc, in which case 50,000 is not given. And they are coming and telling you, tell me what is the salary as per normal regime, you have to give 50,000. So just because the word computed is used does not mean that 50,000 is given. Computed as per which regime is what you have to check. I have noticed this one in the case study questions. In case study questions, they came and said, boss, the income as per new regime is given as so and so number. And they came and said, what will happen if you take the old regime? In that case, you have to reduce 50,000, you have to reduce all those numbers and be careful about it. Clear? Be extremely careful about it. Received indale, you have to reduce the deductions. Income word indale, don't reduce the deductions. Computed indalo, don't reduce the deductions as long as it is old regime. If it is a new regime, then you have to do that. Clear? Yes, this is your 30% criteria. The moment you are giving this 30% criteria, no other deductions are permitted to you, which means rent, land tax, this tax, the tax, any kind of higher charges, painting charges, nothing is allowed as deduction. Coming to the last part called as interest on loan. Income tax is coming and saying that, boss, if you have an interest on loan, tell me whether the interest on loan is for a SOP property or a LOP property. When I use the word LOP, I also mean DLOP. If you have a property which is either SOP or DLOP, income tax comes and says, if it is LOP or DLOP, I don't have a problem. Any interest you got is fully allowed as deduction. But if you are in SOP property, I'm giving you a limit. You have to satisfy the limit. If you satisfy the limit, you get 2 lakhs per house. If you don't satisfy the limit, you get 30,000 per house. Yes. What are the limits, Rahul? You have been given 4 conditions. Condition number 1, loan should be taken after 1999. Condition number 2, it should be for purpose of acquisition or construction. Condition number 3, the property should be completed within 5 years of taking the loan. The property should be completed within 5 years of taking the loan. 4th condition will not be there in the MOOC. Just to clarify, 4th condition is CA has to give a certificate for it. Condition number 4 is not important from exam perspective. No one is going to ask you to give certificate in office and all. Okay, exam Puerto Rico, no one is asking certificates and also first three conditions: loan after 1999, loan taken for acquisition purchase, loan house completed within 5 years of loan. Satisfy the condition, you will get 2 lakhs per house. Don't satisfy the condition, you will get 30,000 per house. But please understand, if you have two houses, both houses put together also you cannot claim more than 2 lakhs. What? Both houses put together also you cannot claim more than 2 lakhs. That is what the rule is. That is what the rule is. Clear? Yes. At the same time, please also understand this 2 lakhs or 30,000 which I have told you is per owner. Which means if at all this house is jointly owned by two owners, in that case I can also claim a separate 2 lakhs. He can also claim a separate 2 lakhs. Yes or no? Yes or no? This is what your conditions are. At the same time, they are coming and clarifying that, boss, you can take a loan. I will allow the interest. If you have taken a loan to repay your old loan, new loan or the interest is allowed. But if you have taken a loan to do anything else, interest is not allowed. If you have taken a loan to pay municipal tax, not allowed. If you have taken a loan to pay municipal tax, not allowed. If you have taken a loan for paying loan only, it is allowed. Okay, loan taken for the purpose of municipal tax and all is not allowed. I have taken a loan for repaying my interest on the old loan. Not allowed. The loan should be taken for the purpose of repaying the old loan which is used for the house. This loan is taken for the purpose of repaying interest. Not allowed. Rahul, interest on interest. Not allowed. Penalty paid. Not allowed. Okay. The only one amount which I am going to allow is the interest on the loan which is taken for the house, or the interest on the new loan which is taken to repay the old loan. That is what will be allowed. At the same time, if you have taken the loan from a foreign company or a foreign place, then in that case you will allow interest only if TDS is deducted. TDS not deducted, no interest allowed. TDS not deducted, no interest is allowed. Clear, not clear? Yes. This is what your interest on loan is. Any doubts? No. At this point of time, you will complete your income from house property. You will complete your income from house property with some special scenarios given to you from your exam perspective. First special scenario comes and says that you have one house. That one house part is self-occupied, part is let out. Same house, part SOP, part LOP. Same house, part SOP and part LOP. Income tax comes and says you do one thing, you split everything off. Municipal value will get split, fair rent will get split, standard rent will get split, actual rent will be only for the LOP part. Actual rent will only be for the LOP part. Compare and find out the GAV for the let out portion. GAV for the SOP will become 0. Loan also will get split. Between SOP and LOP. SOP portion you can claim 2 lakhs or 30,000. LOP portion you can claim full thing. Yes or no? Yes, this is your first thing. Second one, they are coming and saying, Rahul, I have a same house. Part of the year it was SOP, part of the year it was LOP. What? Part of the year it was SOP and part of the year it was LOP. Income tax is now coming and saying, if that is the scenario, assume that the house was LOP for the whole year. For the whole year put together, you got the actual rent. Which means in this scenario, you will not assume the actual rent ignoring vacancy and all. You will take the actual rent. What rent you received for that respective months will be compared with your expected rent for the whole year. So even if you have got expected rent for 12 months and actual rent only for 9 months, compare those two, whichever is higher. But here what will happen, since you have considered the whole house as LOP house, interest fully will become allowable. I will not come and say, boss, split into SOP, split into LOP, not required. Everything will become allowable for you. Rahul, in exam, how to understand whether this is a part SOP, part LOP house or is it a vacancy house? Question will come and tell you. It will come and say that the house was vacant for so and so months. It means it is vacancy. Question comes and says, no, the person itself was living in that house. That means it is part SOP and part LOP. Understand the difference very clearly. Yes? Last scenario, I am coming and saying the house is joint owned. What owned? Joint owned. Two owners are there of the house. In that case, what I will do is, I will recommend you do one thing. You take till NAV. Assuming there is only one owner. Then after you get the NAV, then split it into both the parties. Don't split after finding the income itself. Split at the NAV level, because I told you per owner will get 2 lakhs interest. NAV level split off, then do 30% for both partners individually, and then do interest loan for both partners individually. Both partners will get 2 lakhs each. This is what the criteria are. Clear? Yes. The last part of the chapter is called as pre-construction or pre-acquisition interest. What interest? Pre-construction or pre-acquisition interest. Income tax comes and says that, boss, if at all the loan was taken prior to the house being completed, that interest can never be allowed as a deduction because the house is not ready. Okay, so for all the period where the house was not ready, it will be called as pre-construction interest or pre-acquisition interest. Rahul, how to find out when is the house ready? The house will be ready the moment the house is ready in one financial year, which means the whole of that financial year will not be considered as pre-construction period. In simple words, from the date on which you took the loan till the last day of the preceding previous year, assuming your house got completed in 22-23. What 22-23, you will take the loan up to 31st March 22. That will become your pre-construction period. The interest will be allowed over a period of 5 years. Please understand, when I say the word allowed, it means it will be added to your SOP or LOP. If after adding also you are not satisfying 2 lakhs, then only you can claim the number. If after adding it goes beyond 2 lakhs, restricted to 2 lakhs. Understand, it is not that you can take current year interest up to 2 lakhs and then last year's order interest fully allowed. Current year plus last year all put together, maximum 2 lakhs. Yes or no? Look at the example. It comes and says, Manshika has taken a loan of 25 lakhs at the rate of 10% on 1st October 2019 for constructing her house property. The construction was completed on 30th June 2020, which means the house was completed in the previous year 21. House was completed in the previous year 22-23. Which means your pre-construction period will be for the period 1st October 19 to 31st March 22. Because this year order full interest will be allowed. Last 31st March the interest will become your pre-construction interest. This period order interest is computed as 6.25 lakhs. How much? This 6.25 lakhs. This 6.25 lakhs will be divided by 5. Number will become 1.25 lakhs. This 1.25 lakhs is the interest of pre-construction period, which I am going to allow for the 5 years. Rahul, from when? From the year in which the house was completed. Which means from 22-23. Then I have to also include my current year interest. Current year the loan was available till 30th October. Yes, basis that my interest has become 1,45,833. On this I will also include my last pre-construction interest, which is 1,25,000. Total has become 2,70,833. Rahul, can I claim this 2,70,833? Yes, provided it is LOP. If it is SOP, Rahul, restrict to 2 lakhs. Why, Rahul, 2 lakhs? Because all conditions are satisfied. Loan was taken after 1999. Loan is taken for construction. House is completed within 5 years. All conditions satisfied. So the loan amount has become 2 lakhs. Rahul, I wanted interest full. I only got 2 lakhs. Balance 70,000 wasted, Rahul. Yes, the balance 70,000 is wasted, but you can utilize it in chapter 6A. Provided some conditions are satisfied. What conditions we will discuss? Yes, the conditions we will discuss, but this is what the rules are. Any doubts here? No? Great. This marks the end of your HP chapter. In this HP chapter, from 115 BSc perspective, Rahul, what is changing? From 115 BSc perspective, SOP part is deleted. Which means if you have any kind of interest on the loan taken for SOP, it will not be allowed as a deduction. LOP, DLOP continues. Which means 30% allowed, interest on loan also allowed. The only thing which is not allowed is SOP. Clear with me? Can we go forward? Yes, awesome.